All right. Well, welcome everybody. We have a panel here of right now. We have two of the best of the best. We have Chris Norton with iBankers Direct, one of the premier broker dealers in the space. Then we have my good buddy Nate Dodson. Nate Dodson, one of the most experienced securities attorneys in the country. He is really going to be bringing some fantastic expertise into this discussion. And I believe we might have Frank Bellotti with 21st Capital joining us as well. But we'll go ahead and get started with Chris and Nate. Gentlemen, how are you today?
Doing great.
Doing-
Thank you for asking.
Doing great. Still trying to figure out this whole techie make my camera work, but working on it.
Yeah, hey, Nate, it's funny because I had to go in and use Google on mine. I was using Safari and I had a couple issues, so I had some issues as well with it. But well, what I wanted to start off with, gentlemen, is obviously we're going to be talking about real estate. We're talking about the Jobs Act, and obviously we're talking about then adding in tokenization. And I think ultimately, as Oscar had said, kind of in the opening, ground zero is the essentially the regulations. Whether you're going to sell a traditional security, whether you're going to sell a hybrid security, there's Nate. It really does come down to the regulations first and foremost, because that's the vehicle that you're going to be using to go to the market and offer the securities. And in general, there's really kind of three primary programs available that most people would use: Regulation D, Regulation CF. We're actually seeing real estate operators use ever since they took the limit up to 5 million, and then also Regulation A plus. Nate, why don't we start with you? Do you want to just give us a quick rundown on those three programs and just kind of the benefits and disadvantages of them? It doesn't need to be super in depth. Obviously, you could speak for hours on those three programs, but just to kind of give a little bit of a background to the audience as far as what are the options there, because that is going to be the starting point. That's the vehicle they're going to use to offer these securities.
Sounds real good to me. Well, at the end of the day, we're all here and learning about this because of the general solicitation, the marketing options that are available under the regulations we're going to talk about, with kind of the most classic one being Regulation D, traditionally now the Rule 506C, which allows the advertising and marketing everywhere, as long as you're only working with the verified accredited investors. So definitely a nice way to get to the closing table on the real estate, because you can get there quick and easy, but you have a very small pool with the accredited only. You expand the pool a little bit with Regulation CF, quite literally that regulation crowdfunding, that allows you to now accept capital from everybody, accredited or non-accredited, subject to some limitations. But now you're dealing with the limitation of only being able to raise up to $5 million. Great for the little deals, but if you're looking to do the $20 million, $50 million fund capital raise, then you're really probably targeting more the Regulation A options, which again, you can accept the capital from the accredited or non-accredited investors. You can generally solicit, market everywhere, but now you're capped at $75 million in total, and you go through much deeper dive qualification process with the SEC that costs a little bit more, takes a little bit longer, but ultimately is setting up more of a long-term, larger platform compared to the Regulation CF, and more versatility than the Reg D quite often.
Yeah, and actually, to jump ahead real quick, Nate, because I'm kind of interested to hear your thoughts on this. So with Reg A, the Reg A does have to pass a qualification process with the SEC. So you are going to have an SEC examiner reviewing the Form 1A, reviewing the exhibits. Do you see any kind of situations where selling a token might increase or create some complexities there, like maybe increase the potential for comments or what have you? What are your thoughts on that?
My thoughts are what's been going on in the tokenization world is not going to go on in the future because of exactly what you're nailing with the SEC is hyper interested in the tokenization and what's going on in the crypto world. They're interested, but they're still trying to figure out really what's going on. And I don't think they really understand what's a security, what's not a security. And the SEC itself, which kind of makes it an interesting perspective that you assume that they know everything, but we're seeing in the crypto markets, they're just bringing lawsuits right and left, trying to figure out where kind of the end of their jurisdiction begins and where really the tokenization, not as a security, really starts.
Yeah. Well, and it's kind of a maturity thing, isn't it? I mean, like LLCs have been around forever. There's obviously tremendous backstop in terms of, legal work for operating agreements and membership interests and what have you. And all that's very straightforward. And yet obviously the token stuff's new. So, we see people where they kind of big picture it like we want to sell a token. But ultimately, they haven't sat with Nate Dodson and said, well, hey, what's the rights document look like for this? You're going to have essentially a certificate of designation, if you want to think of it that way, when it comes to this. And that also then is where you really need to have the proper professionals on board, because if you don't have a rights document outlining the rights and the terms of those hybrid securities of those tokens, and you're coming in through Reg A especially, you're probably going to get some comments because those examiners at the SEC they're going to be asking some questions on that. Chris, so let's go to you real quick, Chris. As far as the real estate and the token angle, what do you see a lot as far as a broker dealer and the use of tokens with real estate? Like what type of deals do you guys tend to see there? Is it existing assets where they're looking to get liquidity and they want to tokenize but still maintain control of the asset? Or is it more like real estate funds where they're acquiring assets? I mean, on the broker dealer side, what do you tend to see?
I'm having more people ask me questions regarding, the ability to tokenize, to denominate out smaller interests on people that are looking to liquidate but still keep control of the property. And the feedback that I'm kind of giving them to an extent is that you could tokenize, but you don't know that wherever you tokenize, you don't know that there's a buyer on the other end. So until the markets become a little bit more liquid, it may not make sense for everyone.
Yeah, and I guess that's a good point too, right? Is the attractiveness and the sales aspect of this, that ultimately, if you have a token that's going out, is that going to be the right fit for the audience? Is the audience that you're going to, as far as the investor audience, are they going to understand that token? Are they going to feel comfortable investing into it? And again, that drives back to back to the work that Nate would do, right? I mean, you got to make sure all this stuff is backstopped properly. So. Do you have any feelings on that, Chris? I mean, if someone wants to execute a token offering, I mean, are you seeing these kind of deals where they are being sold and people understand these securities, or is there still some hesitancy there because it is new?
I think there's still some hesitancy there because it's so new. I think as more people adopt and the market becomes more and more liquid and more people understand what they're signing up for, getting themselves into when they purchase a token, I think that barrier to entry will be reduced. But as far as like right now, it's still super new. So if you're going to go and do one of those offerings, you really need to educate, the public to be able to get them to be interested in it. So I think that there's still some ways to go on it.
Nate, as far as when we look at these deals, when you start looking at tokenizing real estate, what are some of the challenges there that are let's just say a property owner. Let's go ahead and put an example on the table. I'm a property owner. I own a multifamily property. I would like to get some liquidity, and I'm going to go ahead and tokenize the asset and sell these tokens. What are some of the challenges that I may face And I say challenges. Maybe what are some of the advantages then of the tokens as compared to, say, a traditional structure? Let's start with challenges. What challenges would I face? I'm sitting in your office, Nate. I got this real estate asset. I've heard about this token stuff. What would you tell me as far as, look, Doug, here's some of the challenges you might face going this route?
The way that I really coach any of our clients is starting with, well, why do you want to tokenize and what do you think the benefits really are? Because I think there's a misunderstanding at the end of the day with the vast majority of people in the market. They hear tokenization, they hear crowdfunding, they hear cryptocurrency, and it's just buzzwords, buzzwords, buzzwords. And I really want people to kind of understand that there's some benefits to the tokenization in terms of the ease of transfers and the possibility for secondary markets that really still need to come to fruition. But what's a token? If you ask me, well, it's as great as this old stock certificate that we used to have around a lot. And now, very few deals end up being certificated. And now we're talking about, well, now it's a token. Well, really, what's the benefit of that? It's the same kind of benefit at the end of the day, at least in my perspective, as having that stock certificate. It's nice to be able to hand over some sort of representation of the interest, and the tokenization very much helps that now all of a sudden, instead of saying, hey, I want to buy your stock, will you mail me the certificate? That never really actually happens. To now we can create an online secondary market or a trading platform where I can put that same certificate, that same token on there, make an offer for people to buy in. And now it's just more of a seamless process compared to what happened in the past.
Yeah. Well, and I tell you too, one of the things that I think is interesting is that, at least from what I always heard, that, the benefit of the token angle was that there would be, secondary markets where you could gain liquidity. But what's interesting is with the advent of all these ATS systems now, there is that liquidity option for membership interests or limited partnership interests. So there's a bit of a leveling of a playing field there, I think, as well. As far as the the sales aspect, I mean, I do think one of the things that's interesting, and I'll kind of kick this over to Chris to get his thoughts, but one of the things that I've always seen, and I think part of the reason why I'm seeing a lot of people gravitate towards CF and Reg A for these real estate transactions, is that everybody can get their arms around real estate investing. When you start talking about biotech companies doing offerings and stuff, you kind of run into a little bit of a risk that these concepts are going to fly above the head of some of people, myself included. Real estate's different. Real estate people can understand these things. I mean, I've got guys coming through doing vacation rental funds where they're buying properties at beach resorts, lakes, and out by ski mountains. And it's like, when you think about it, those are places that people are going to vacation, but they're also places where they're only building so much coastline, for example. So I think when you look at the use of CF and Reg A and being able to access the entire investing public, real estate kind of is a bit of a natural fit there because of that. Chris, what are you seeing there? I mean, when you have clients that come through, do you kind of prefer them to be in those programs where they can access the entire investing public? And then, do you feel like, as far as being a broker dealer, that's extra sophistication that's in a Reg A, do you feel like that benefits you as well? That you've got some backstops there that may not be in a Reg D, like audited financials or the requirement for a transfer agent, what have you?
Yeah, I think I do think that the barrier to entry in terms of launching a Reg CF or a Reg A for real estate, I think, is a lot easier than like you said, a biotech, a technology company, because like you said, people do understand real estate, and it's not going to fly over the head of a lot of people. And then from the due diligence perspective, it's nice to have the audited financials that you get along with the Reg A, whereas a lot of companies at that stage don't necessarily have that yet. It's definitely a nice component of it that you have that with the Reg A, to fall back on in terms of the due diligence perspective.
Yeah. we'll kind of pop in and do a couple of these questions here, just because a couple of these are pretty good. So my good friend Laura Pamasian had a question about reduction in timeline for Reg A qualifications. Look, I think ultimately on the real estate side, at least from what I've seen, and submitting these filings, real estate stuff tends to be pretty straightforward. So as far as the qualification goes, when you've got a good firm on board, when you've got a Nate Dodson on board, I mean, you're probably not going to run into comments on a typical real estate deal. It's not a guarantee, obviously, but the real estate stuff tends to be pretty straightforward. So you could see anywhere from a 3 to 5 day turnaround from the SEC if there's no comments or a no review situation. If there are comments on a Reg A, it might be about 2 weeks before you get that comment letter from them. And then as long as they're pretty straightforward, you could turn those around in a day or two and usually get it back over to the SEC. I think, Nate, when we start looking at, where do you start on this? Let's say you got a real estate developer, he needs to raise some outside capital for a development project. And he knows how to develop real estate, but he doesn't really understand, how do I go syndicate capital? This is going to be my first syndication. He may not even have an entity formed yet for this thing. So where do they start? I mean, obviously the first thing is they need to pick up the phone and call someone like you that is going to be able to get that vehicle in place for them and do it properly. But where really kind of should they start, and what do kind of the pieces of putting one of these offerings in place look like? I mean, there's entity formation, they got to choose an exemption, there's going to be filing work and offering docs drafted, but where does that start? If I'm a syndicator sitting here and I've never done this before, what's my first step, Nate?
If you reached out to crowdfunding lawyers, we always start with just some information gathering that is really more than, hey, what securities exemption is it? Well, I kind of take the approach that most people really don't know. They have their ideas of where they're going to find their investments. They have their ideas of how much money do they need. They may even have their plans of, we've got to have it by this drop dead day to get through the closing table. But they don't really understand the different strategies and timelines that are available to them. And I love that people are asking about, how's the timelines working with these Regulation A offerings? And it's, Doug, you're spot on. If you get these no review letters, or if there's no comments, things can turn around relatively quickly. But if you start to get comments back, and generally with the Regulation A as an example, if you're looking at 75 million, you're usually not doing like we've got to get to the closing table within the next 90 days type transaction. It starts to more or less limit what regulatory options you may have of when you need to actually close, as well as, of course, of, by the time you get to the closing table, how much money do you need, which also helps define does a Regulation CF work because of the $5 million cap? Or are you really almost stuck with the Reg D because you don't have a lot of time and you need a bunch of money? You can't even make it through the Regulation A process. So the getting to know really what the goals are and where a client believes that they're going to get the capital from is a lot of the first steps of getting to know really the planning, the structure of what goes out to the market.
Yeah. Well, and I tell you too, ultimately what you'll find a lot of times is that, if you're coming in under Reg A plus and you don't keep things straightforward, that is obviously when you could start running into comments. So instead of just having physical asset purchases, you want to start trying to mix in buying securities of other funds. And now you're stepping into investment company act considerations and stuff. I mean, all those things start to impact how quickly and if you will get qualified under Reg A. Chris, let's chat for a sec about a broker dealer's role, because I know there's a lot of people sitting out there. They're going to have a pretty good understanding probably of Nate's role, because Nate's going to be there drafting offering docs and giving them legal advice on these processes. Where does the broker dealer fit in on this? Because I think a lot of people, kind of just automatically look at a broker dealer as they're going to go raise capital. when in fact, a big piece of what a broker dealer does is they are kind of that compliance backstop, or at least especially a firm like iBankers, they're kind of the compliance backstop for the client. So for the benefit of these people on the podcast today, where does the broker dealer fit into these deals?
Yeah, the broker dealer fits in a lot differently on like a Reg D than they would on a Reg CF or a Reg A. On a Reg D, the broker dealer's role for the most part would be to go out there and to raise the capital for the deal on a Reg D. On a Reg CF or a Reg A, it really changes more to a compliance function to a degree where we're responsible for the, I guess you would say, AML, KYC, making sure that the investors coming into the offering, are not doing anything, are allowed to come into the offering, for lack of a better term. So it changes from more of a capital raising function on a Reg D to on a Reg A or a Reg CF, more of a compliance function.
So
there are some caveats to that. There are some broker dealers out there that, will help push investors through the pipeline if they go online and they subscribe to the Invest Now button and they haven't gone out there and filled out all the forms. There are some broker dealers that will contact those investors and reach out to them and try to push them through the pipeline. But for the most part, it's a compliance function.
Okay. Yeah. Well, and it is interesting because ultimately one of the things that's changed dramatically, in the last 10 years, obviously the Jobs Act, but the technology that's backstopping these offerings now, we're really kind of moving into calling it online capital formation, because a lot of these processes that used to happen the old school way, it's all automated now. And, I see Nate shaking, nod, because Nate remembers those old school days of, emailing PPMs back and forth, and you couldn't generally solicit anything. I tell people a lot of times that, if I was having this conversation with you in 2005, the options were so limited. You basically had the old Reg D program, and that was pretty much it. No one was really using Reg A because it was the old Reg A where you had to qualify at the state and federal level. And so I think what is interesting too is with this concept of online capital formation and the fact that everything now is it's very sophisticated. Everything's online. I tell people, when you're using a CoreConnect's backend as far as their subscription process, it takes you longer to buy a T-shirt on Amazon's website than it would be to invest in someone's real estate fund using this technology. Nate, what have you seen as far as that? It really is interesting, the technology advancements. You've been around this business a long time. You remember the old school days. They kind of seem archaic now, don't they?
I love when I see a PPM and it still has the PPM number right at the top, because you're supposed to keep up with these things. But now all of a sudden the technology just kind of really handles it all for you. I almost see the broker dealer's role in general has gone from the financial sales to the technology compliance to a large extent. Unless they're overseeing the sales representatives. But really, at the end of the day, the ability for an investor to find whatever out of the sea of opportunities online, to within an hour find it, qualify, do your due diligence, and invest. Just how streamlined and simplified it is compared to the years of the past. Not only does it make it easier, but it also has greatly increased the amount of retail and private investors that are willing to get into it, and just getting over the procedural, well, I'm not sure how this takes place. There's a level of comfort knowing that, there's this technology behind CoreConnects that is just simplifying the information intake. Plus, there's an assumption that from a suitability standard, that the broker dealers or other people are actually looking over the information to make sure that, standardized processes work, so you don't have as many fly-by-night guys out there.
Yeah. Well, and I tell you what, it helps on the sales process because it builds confidence, right? I come to a raise portal, there's a custom raise portal, there's a broker dealer on board, there's a transfer agent on board, there's escrow on board, there's kind of that circle of trust there that's front and center. Makes me feel better. Chris, that technology's probably made your job a lot easier, hasn't it? Being able to track things and get KYC and AML work done and everything, and clear securities before someone draws off escrow. I mean, the technology piece has got to have made the broker dealer piece a lot easier, hasn't it?
Yeah, it's made the process seamless to an extent where, definitely leaps and bounds from where it was on like an old school Reg D. This is much, much different and much more seamless.
Nate, let's talk about entity types. I mean, this is kind of a starting point for real estate capital raising. So ultimately, I'm going to drive back to be the new real estate syndicator. What are my options there? I mean, I could do obviously there's a lot of real estate stuff that happens under LLCs. We still obviously see LPGP structures for real estate stuff, and we see corporations used. I mean, I think a lot of times that tends to be if it's going to be a REIT structure, but it'd probably be helpful for everyone to kind of hear from you on that as far as what am I looking at as far as the entity that I would form? Obviously, a lot of that may be driven by the project. If it's going to be short term, and I'm not really looking for a tax benefit there for investors, it might just be a simple LLC for an infill site development project. But what do we typically see there as it relates to real estate and the entities used?
Well, I think it's hilarious that you bring up the old limited partnerships, the GP, LP structures. But at the end of the day, people kind of use those words no matter what type of entity is. A general partner is the management of a limited partnership. But I don't know, maybe 4 or 5% of the time, maybe we'll use an LP. Limited partnership structure, most of the time it's using limited liability companies, the LLCs. They're just honestly the easiest to document for people to understand. There's flexibility there. And ultimately, you can pick your tax category, which I think can be one of the biggest benefits of the LLCs. Where partnership, the GP/LP taxation, you can have that. If it makes sense to be a REIT, no problem. And people don't really realize a REIT, a real estate investment trust, isn't a trust at all. Generally, it's a corporation that's electing to be taxed as a real estate investment trust. Well, we can use an LLC for that as well, because we can choose the corporate REIT tax category. So for that reason, for these reasons, as well as some of the asset protection components of it, the LLCs are honestly used almost probably 90% of the time. And then, of course, we're still using corporations some if we're doing more of a JV where it can be a subchapter S corporation with the direct pass-through. We don't see that too often on the real estate side because it takes away the opportunities to have like preferred returns, which is just kind of created a standard expectation with real estate investors. However, we'll still use either an LLC tax as a corporation or a corporation if we're putting together a REIT.
Yeah, and it is interesting how a lot of people use those terms interchangeably, because you'll get someone that's got an LLC and they're talking in their corporate info about the general partner and stuff. And like you said, it's almost kind of interchangeable these days when you think about it. I mean, a lot of people are really familiar with manager managed LLCs, multiple classes of membership interests in those LLCs, gives you flexibility to create a security that's going to meet the needs of your investors. Chris, on the broker dealer side, what do you typically see, and do you run into any resistance from investors on any structures? Like, would you run into a resistance from someone with something like a limited partnership structure where maybe it's an older structure that maybe they've just kind of, they've always thought of LPGP stuff as being an oil and gas, for example. But do you run into anything like that, comments or feedback from investors where they maybe don't understand a structure like that?
It depends on what type of investor that it is. If it's a super high net worth investor, those investors are definitely familiar with the GPLP structure and they have no problem with it. If you're targeting like a general, anyone, non-accredited investors, I think maybe it'd be a little bit more complicated for them. So I think it's based on which investors coming into the deal and how the deal is structured, would really determine on whether you get pushback on it or not. We have, funds here, venture funds, where we have a GPLP structure, and it's only from existing clients of ours at the fund, so we're not generally soliciting to the public, and we haven't had issues with it. But I could imagine if there's an easier way, that guys would rather go that route. But we've been using it and haven't had issues.
Nate, as far as like liquidity provisions, so if you look at putting together something like a real estate fund, there are a lot of times there's kind of two ways to look at it. Hey, I'm going to run this fund for 5 to 7 years. We're going to liquidate assets, go to all cash, and that's going to be the exit. You also have people that really want to run more of kind of like an evergreen fund. That fund's just going to keep running, but obviously at some point you got to provide liquidity. Again, I'll be the real estate guy. I mean, how do I handle that? If I just want to keep running this fund and I don't want to sell assets, obviously at some point investors are going to want liquidity. Well, what do those options look like?
And that's where it gets to be very difficult talking about how do you exit a fund that is set up to not just sit on a bunch of cash. It's a little bit different than investing into an equity pool or a stock mutual fund where, hey, we need liquidity. We can just go out and sell it the next day. With real estate, you have to have a long enough timeline that it allows the GP, the management, to refi or sell assets, or to have another mechanism to create that liquidity like a secondary market. But generally, if we're working with somebody that says, I want to hold on to these assets forever, and the response is, your investors don't want to hold on to those assets forever, we work through and kind of talk about the pros and cons with a redemption or withdrawal policy that maybe it is only once a year. Oftentimes there may be a 4 to 6 month allowance to get people's funds out, but it's not necessarily an ongoing, hey, you can sell or ask for your money back at any time. One of the biggest issues that I always see in thinking about real estate is what's a fair market value? And to really have any accuracy with it, you've got to do appraisals or at a minimum broker price opinions for all this real estate assets to come up with a fair market value. That is just very unreasonable to be able to accomplish that on an ongoing daily basis.
Yeah. And that is something to think about too, obviously. I mean, if you want to have a liquidity every 6 months and you're trying to determine a NAV, and you've got to obviously have a valuation on that portfolio to determine the NAV, you're obviously going to be working hard on those appraisals or broker price opinions. Chris, as far as asset class, I mean, do you see any kind of preferred asset class at this point from investors? Are people gravitating towards multifam, vacation rentals, single families? I mean, do you see any trends there, or is it kind of all over the map right now?
I think it's a bit all over the map. We're not, we do a little bit in the real estate space, but that's not our bread and butter. So I don't know that I would be the best guy to give an opinion on that. Nathan might be able to offer a bit of a deeper insight than I would, but from what we're seeing, it's all over the map. Okay.
Yeah. So as far as Nate, when I'm looking at the kind of the liability protections on stuff. So let's say that I am a syndicator. I'm going to raise money. I'm going to build out a portfolio. And as far as the management goes, what does the management structure look like? I mean, is it myself and my 2 other partners personally on that LLC as managers? Are there manager entities involved? Let's maybe touch on real quick kind of that org chart as far as what that tends to look like. And let's just keep it simple and say it's going to be an LLC.
Well, sounds good. LLC, the top dog of the LLC is the manager, which I always thought was a little bit weird. The manager, kind of like that president of a LLC. It can be a person, it can be an entity. We're pretty consistent we're recommending people have a management entity that the investors aren't coming into It does allow more flexibility from the management side. Oftentimes you may have GP teams, management teams that are coming together, and it's a lot easier for them to come together and have other understandings or agreements that affect management, not necessarily the investment, by using a completely separate entity that serves as that manager. Also, if there's any issues, lawsuits with a property with investors, it'll generally contain it a little bit better within the offering entity or the fund or whatever it may be, as well as that management LLC or corporation that ties into it.
Gotcha. And then that manager then would be taking things like management fees, acquisition fees, disposition fees. And then the structure we tend to see is there'd be a separate kind of sponsor entity that would hold Class B interests, for example, in the fund, and that's allowing them to participate. As far as asset classes, I'll just talk. I mean, I get a lot of people that ask, hey, what can I raise money for? And really across all asset classes. I mean, I've seen people doing single family home portfolios. And a lot of times, a lot of these people are coming out of the property management background where they've been managing these properties. They have some expertise. They've never done a fund before. They've never syndicated capital before, but they want to go ahead and put their talents to use in that regard. Obviously, you can step into looking at multifam, commercial, self-storage. I think what I see a lot is people really looking for niches, vacation rental stuff. I've seen a lot of that recently where they're buying properties in, by Vail, for example, or they're buying beach properties where, these properties are going to have a better chance at holding value because it's a unique place. And so I think, it's interesting looking at the different types. We've even seen things like, land banks, entitlement type deals. So ultimately, if you're out there and you're looking to do, syndicate capital for real estate and you're curious, like, hey, can I do this? Pick up the phone, call a professional, call Nate Dodson, because ultimately, there's a lot of different ways that you could set these deals up. There's a lot of different asset classes that you can invest into. And a lot of times it just takes getting one in place. I mean, there's always a first step for people. I think one of the key things is put a good team in place. If you have a good team supporting you through this process, it's going to be a lot easier for you to get through the process with confidence and know you're doing things properly. And I think that's one of the big key things. And I know Nate and Chris probably run into this a lot when you're doing your due diligence, and that is, hey, have you sold securities before? Or, have you had any rounds from this company that you've executed? And then you find out, well, we did a friends and family round that actually was like 38 people and we didn't make any filings. So I think ultimately, too, that's one of the points to really drive home here. There are rules that apply to you going and raising money. You can't just spin up an LLC and go out on LinkedIn and start telling people to come buy membership interest in your LLC. There are rules that apply to that. That's why this ecosystem is in place, is to get you through that process so that you don't run afoul of rules and you do everything properly. Because the last thing you want is to do something improperly and have rescission issues happening, or obviously have state or federal regulators coming in and looking at you. So that's one of the big things right there, is just know the fact that there are rules that apply. If you have any questions on that, obviously pick the phone up, call me, call Nate, call Chris, but, call CoreConnect. But I mean, I've always been surprised how many times, especially in real estate, where operators just didn't think rules were going to apply to them and then ended up having a problem. So that's why these programs are here. And look, they give you the ability to generally solicit. I mean, the technology and the programs now are phenomenal. So there's no excuse not to come through and do a proper offering and do everything properly. We're at the end here. Nate, as always, wealth of knowledge. Thank you so much for being on the panel. Chris, fantastic to get your viewpoint from the broker-dealer angle on all this. Very excited to have you guys on. And it was great having a discussion on, obviously real estate and these programs, and then mixing that token angle in as well.
Yeah.
Thank y'all so much.
Thank you, guys.
All right. Thank you.
Thanks, Doug. CoreConnect.
Okay.